what I'm saying is silver drops 5% and everyone gets short on CTA side. It's good for 2%. We got that in July. Like, bing. I'm like, okay, we're done. And it went down. I was like, oh, I'm a genius, right? Bing. Okay, we're done. Boom. It goes up. What was that about? And that was the banks saying, we're going to let you suffer a little bit more.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics, and we are recording Tuesday, October 4th. Fortunately, silver and gold rallying again on the day. Been quite an interesting start to the month of October. And I couldn't think of anyone better to bring in to break down what is going on in these gold and silver markets than Vince, the Professor Lanci, partner at Echo Bay Partners, also founder of GoldFix Substack, which I know, Vince, you probably didn't want me to mention this, but in the month or so now that I've been subscribed, some of the best insight into gold and silver that I've come across in the time that I've been doing this. So, Vince, it's a pleasure to have you back on in here today, and we've already had fun talking about a lot of things before we hit the record button. So, first of all, before we get started, how are you doing today, sir?
I'm doing well. Thank you. Thank you very much for that comment. You just called me on a good month. Next month, you'll be cursing me if silver goes down or I'm wrong about something, which happens all the time. But thank you. I appreciate it. Thank you very much. That means a lot.
Well, I don't know if that's quite the case because as we were discussing, the markets don't go in a straight line. There are times where they are up, times when they are down, and hopefully try to learn a little bit from each of those. Although, again, today, as we dig in on Tuesday, gold up $30 on the day at 1732, and silver after a big Monday where it's up about $1.70. We see another 50 cents today.
Yeah.
And as you have been discussing in that GoldFix Substack, had been a lot of banks advising the commodity trade advisors to go short as a hedge to the stock market. And at the same time, we've seen the COT report show, especially in silver, the banks getting on the long side. We've seen silver lease rates, the hard to borrow rate for SLV shares go up, indicating that there is pressure that perhaps has exploded these first 2 days. So be curious to hear, most of all, what you're thinking on that.
The first thing I want to just bring up, because it's happened 2 days out of the last 3, I think, is just to get gold out of the way here. There's a statistically backed thing. If you look up gold on 2% up days, it almost, and I know that I'm using a superlative here, it almost never goes over up 2%. Never. And the reason for that, the rumor is because 2% is where Benoit Gilson, the guy at the IMF or the BIS or wherever he is, they're not allowed to let it go more than 2% higher because they don't want it to be in the headline. So it's a little bit of conspiratorial stuff. But if you look at it statistically, if throughout history, since 1987, if gold's up 2%, a week later, it's down more than 2%. And we feel that as investors, especially in silver. Anyway, I just wanted to know that because on my alt Twitter account, I'm like, oh, look, gold's up 2% today. That's the top for today. Maybe it'll go up 2% tomorrow, but they just won't let it go. Anyway, moving on to silver, they will let silver go if there's money to be made off of it. And that's what's been happening. The comment about the commitment of traders, the CTAs, that has been the driver. And beyond what I thought it would be, to be fair. So just to recap the driver of this rally, of these recent rallies, not just the last 3 days, is that during we were talking about generations earlier, right? There are generationally younger than our age and younger, certainly younger than me, has been trained to believe that silver and gold don't go up, and you can call them, fiat idiots, whatever you want to call them, but people that really that are very legitimately neo-Keynesian, they believe that precious metals shouldn't go up because they do nothing, et cetera, right? But so you have a generation steeped in this philosophy now, kind of like we're just buying the dip all the time still, at least I am. And what happens is that mentality, because gold and silver have been horrible in general, not horrible lately, but from 93 to 2001, it was from 2017 to now, it's 1700. Of course, you had some big moves, but what's happened is silver, and you can make the narrative case, and I'm not going to talk about that narrative of, oh, it's a green metal, it's industrial metal, but advisors make the case to their clients. They say, you're long stocks, the Fed's going to raise, we are in a recession, whatever the reason. We want you to hedge, throw a little bit of your speculative money on the hedge side and on the speculative side, I should say, into shorting an economically sensitive metal. And that would be copper and silver. Silver is more bang for the buck. Silver is still controlled by the US time zone. It has more volatility there. Copper, on the other hand, is it's more London-based. Not that silver's not London-based, but the demand's out of China. So the copper market will have bigger moves. The LME contract is more important than the COMEX contract, right? We know that. So the CTAs are advised, well, you don't want to, I'm repeating myself, but I might not have said it on air with you last time. CTAs are like, well, you've got $1 million in stock, and you've got $100,000 with me in commodities in the CTA position, and you don't want to sell your stock. Why don't we hedge you economically by selling some silver, or start with gold? Let's sell some gold, and they'll sell gold and silver. Boom, historically, right? But this time they were more sellers of silver because of the war. CTAs covered their gold on the highs. Boom, they short squeezed themselves on the highs. They had been selling gold in anticipation of recession and Fed hiking. And so the war started, and they covered, and gold went up, and of course they bought the highs. When I say CTA, if you're not familiar with it, CTA, think retail, think unsophisticated retail, which makes a lot of money, but in a tactical way, they're not very sophisticated. So these guys in this cycle, they didn't sell gold and silver. Half of them had sold gold and bought it on the highs. And so now when it's like, let's hedge your economic exposure, like, well, I'm not going to sell gold. I saw what happened last time. Let's sell silver and copper. And so you saw silver really taking on the chin since August, right? Not since August, I'm sorry, since June, since May. My God, since last year.
Around March even.
Since I was 18. No, I'm just kidding. But but yeah, since March, that's when it started, right? And that's kind of what happened. Silver. If you remember when silver and gold dropped, and they dropped, and they were kind of holding up there, and then before gold got hammered post-war, silver got crushed, and the gold-silver ratio, which I trade actively, collapsed, meaning exploded, meaning gold's more valuable relative to silver. And my conclusion that I rationalized for myself was, well, that's because they're buying gold, or they're afraid to sell gold because of the war, but they're not afraid to sell silver. And that was right, but the depth of it I didn't understand. And then come Powell rate hikes, stocks get hit, silver gets hit. Stocks go down 1%, silver goes down 2%. Stocks go down 2%, silver goes down 4%. And I went, okay, so this is the economic play. We're not going to, some people are selling stocks. Everyone who has money in commodities is selling silver. And the CTAs get short. And if you look at the commitment of traders on, wherever you look, you'll see that lately there's been a big comfortable short in silver. Gold will be longs, a little bit of short, longs, a little bit of short. Silver will be like long, short for 6 months, flat. And you'll get that a lot. And we're in one of those cycles now. So I went, okay, so when when something happens that makes the Fed pivot or something like that, you're going to see silver have a short squeeze. And I don't mean a technical short squeeze, I mean a paper short squeeze. And we got one of those. And we got one of those in July. Silver dropped, and then we had a nice rally. And I said, oh, look, the CTAs are buying, they're covering. And then I said to myself, but the funds aren't going to get long. So at the highs, they won't reverse. They're all licking their wounds right now. So the market should retrace lower. And it did, and I was right. And then it went up again. And I went, okay, here we go again. By the way, the EFP tied in with that. right? The market dropped, the physical bids came back. To your point about inventories not being around, the physical bids came back, and I went, wow, like it's the EFP, I should say, not the EFP was bid for physical over futures at the lows, and on the highs, the futures were bid over physical. I'm talking a little fast right now, but it's on top of my mind right now. And but the highs, you had the funds covering, CTAs covering, right? Then the market came off again. And then it happened again. I went, okay, here we go again. We're just going to do one of these. And I went, okay, no big deal. And then I even had a Sunday discussion with some of the guys. And I'm like, I don't think silver's got much more left in it because a lot of the shorts have covered. And I think people are, and I was like, I'd be a buyer of gold after this big run up in silver. I said this on Sunday, this Sunday. And what's happened, as I have done so many times, I've underestimated the power of the short covering rally. And what did we have? I mean, we had 8%, yesterday. It was, I was writing a post, like, okay, I was writing a post, like I was a genius. I was like, okay, this is CTA shorts covering. My first comment was CTA shorts covering. Don't expect gold to catch fire on this. And you know what? I wouldn't buy strength. Like that's what I was saying implicitly, right? And then an hour later, I was like, okay, silver's not up 5% anymore. It's up 8%. I'm wrong. Someone keeps buying. And, but it wasn't physical buying. Still, I underestimated the magnitude of the pain that the shorts are taking. Now, here's the silver lining. I actually said that. Here's the silver lining to this. I normally say, and I'm well paid for saying this, that when the short covering rally is over and we're in the season before Thanksgiving and Christmas, you don't have a lot of fund money getting reallocated. They lick their wounds, they close their books, boom, they're done, right? And I've been, pretty good at handling that. But we overextended. And I'm obviously wrong about my trading. I was like, wow, I underestimated the magnitude of this. And then I asked myself, well, this is true. It's always because the banks decide they can punish them more. Okay. So if you and I are long silver and we have to sell, the banks will be like, well, there's my bid. It's gone. And the market drops 5%. We're like, okay. And typically, and I'm giving you tried and true behavior. Typically, when there's enough shorts in the market, silver rallies 2%. We're like, and the banks go, I'm going to back off to 2.5%. They're comfortable letting you get run in on the short side, but they cap it because they see the flows. They have producers. They have structural reasons to be short. So, it's like down 5% gets you up 2%, down 5%. So the banks influence the markets. Like, so if the shorts are going to cover, we're going to punish them, but we'll let them add at 2% higher. Well, now it's 10%, Chris. Yeah. I'm like, why are the banks? So it's not like, why are we running up? Are the banks in a rush? Are the banks worried? Like, no, the banks are letting it breathe on the upside now because they know, simply put, very, very materialistically, they know they can get away with it. So why can they get away with it? Well, they either see physical buying that we're not seeing yet, right? Or they see a lack of producer selling that we can feel but can't really guarantee. Or they just know they got some big fish on the hook. What I'm saying is silver drops 5% and everyone gets short on CTA side, it's good for 2%. We got that in July. Like, bing. I'm like, okay, we're done. And it went down. I was like, oh, I'm a genius, right? Bing. Okay, we're done. Boom. It goes, what was that about? And that was the banks saying, we're going to let you suffer a little bit more. Now, we could turn around and drop 5% tomorrow. But I want to say this as a trader, and it's complementary to physical accumulators, which I am as well. But as a short-term trader, the fact that the banks are letting it breathe for whatever reason, it could be because of the UK. Who knows? It could be because there is going to be a pivot coming. But the fact that they're letting it breathe more than usual happens when there's either a physical buy or there's a regulatory issue going on. And it happens because they know what's going on. If it's happening and they let it happen, then there's someone who there's room to be punished. And it also means that the regulators are not saying keep a lid on the metals. So I'm happy to be wrong. And what I'm saying is, for decades, the bullion banks have made money being biased short, and every so often they'd squeeze everyone higher. The markets may be, I've said this before and I was wrong, but I'm always on the alert for it. The markets may be telling the banks it's okay to be long now. And that's evidenced in the COT.
Yeah, actually, that leads in with the next thing I'd love to get your opinion on, where we've seen this pattern with, here's the red line showing the commercial short position, and we've seen at the bottom part often when the banks are less short, and that's when the price goes up.
Right.
Well, I guess this would, they're short there, price comes down here, getting pretty short. That's traditionally been, again, here, banks get very short. So we've seen on a wider scale, and I think a lot of people have expected a breakout to the upside in silver, yet as the price goes up, banks get more short, and then we've seen the collapse. Is that your assessment of that as well? And do you think we'll ever get to the point where that changes?
Oh, yeah. I think we will get to that point where it changes. But two things. One is there is, that chart you had up there, which I'm going to ask you to put up again when I get to the specifics of it. But generally speaking, it is a fallacy to think that, and this is what I was taught by the guy who did it. It's a fallacy to think that the banks can only get so short. And meaning the banks, and this is how it was explained to me. It's like, Vince, you borrow for your credit card at 18% or 29%, whatever it is now, 20% call it, and they borrow from the Fed at 1%. So they're short, not because they're bearish, they're short because you're buying. And the reason you end up eventually capitulating in the long term is because at 20%, you get hit on an interest rate ding, which also manifests in the rollover contango. They're borrowing at 1%. They're short, using gold because it's on top of my head, 450,000 shorts. We don't care. So we don't care. We'll keep shorting it because we don't have the hangups that we are the low-cost operators in the industry. We're only selling because you're buying, and we don't care if you're buying because we know that we have a cheaper cost of capital. Eventually, we'll run you in. So a lot of people in the past, and I haven't seen it recently, and I'm actually grateful for it. People like you have been educating audiences on, you're not running in the banks. It's not going to happen without the banks knowing if it's going to happen. So just know that the banks, what they do tells you where the bias is in the market. Anyway, but the more specific thing, if you could pull that graph up again, this Sunday, by the way, it's ironic. This Sunday, I can't see the very bottom. Can you go back to 2018 on the screen?
Yes.
Because I used this chart to make my case that silver was done on Sunday. You ready? All right. So I went, without even looking at it, I went, okay, we're looking at the red line versus the green line, institutions versus the funds, right? The blue line is your small traders, right? Okay. So that'll be like the top. Yeah, exactly. Right there, right? And the small speculators used to matter. They don't matter as much anymore because now the small speculators are the people that are in the CTA funds. So that's why they don't matter as much. But to your point, simply put, you look at the graph and you say, okay, when the red line gets less short, we go up. When the green line gets less long, we go up. And then you say, well, it's even more obvious when the red line crosses the green and the green line is short the market and the red line is long the market, just as an overview. Then I went, okay, right? Everybody in the conversation on Sunday was like, I'm bullish. And I went, let's go back. And I went back to 2018 first. And I went, see that there? November of 2018? Look at how long or less, look at the difference between May of 18 and 2018. I said, look at that. I go, if you had bought silver then, you at best would have broken even. And the moment in November 2018 when the banks started getting short again is when it rallied. Explain that to me. And no one really could. And I had an explanation, of course, because I loaded the dice for this game, right? And I said, okay, but now let's look at examples where it worked. And as you noted, it worked. It worked in looks like June of 2019. There's a good example of it working. And if you don't go back to 2018 and before, you say, well, why wouldn't it happen again? And I'm not going to say it's not going to happen. I'm going to say, again, what was said to me when I was like a youngster. It was, well, Vince, if the normal equilibrium, first of all, this is what I was taught. Ignore the banks. As I said, the banks do what they want, when they want, as many times as they want. And the only reason that they ever close positions is because a trader blows out and gets replaced by another guy who's going to do the same thing. So you and I both work for Goldman Sachs, right? You're trading oil, I'm trading silver, and I'm shorting it, and Buffett comes in and buys it, and I get carried out on a structure. The bank doesn't get carried out. They just give my book to you. And you're like, hey, they're like, Chris, would you cover Vince's stupid silver position? He lost money. It's like, okay, and you buy it, and you run it in. And then at the top, after you buy my position, you sell it out again for yourself. It's amazing. So the reason I bring that up is because analogously is because it's the funds that we care about. We know the banks have almost infinite money with which to play on the future side.
Right.
We know that the funds have a limited amount, some more than others, but generally speaking, if there's only one hedge fund in the world and they've got $1 billion, they put 800 million, let's say, into oil and 200 million into silver. Well, when they put their money in, they're done. They don't put it in anymore. They just hope it keeps going. It's kind of like, are you done buying? Yeah, I'm done buying. Okay. Well, when you're done buying, now let's see how much you can stomach it going up your butt. And that's what's going on, right? So instead of focusing on I'm just giving you the whole rationale about it. Instead of focusing on the banks or the deal, I call it the dealer side. The dealer side, you focus on the fund side. Now we go back to your chart and we go, generally speaking, when the funds get out of all their longs, the risk reward is phenomenal to be long silver and not short. It's that clear. So again, to paraphrase Joe, Vince, the next 50 cents may be lower, but the next $5 is higher. Don't trade big, put it on and make your stops wide as a trader, right? So if you follow that advice and you look at those times that it crosses over in whatever that is, like say September through November of 2018, you get killed or you're flat, but you don't lose a lot of money. And then you do nothing, say you're only trading on that. And then you look at it in June and you buy it, right? June of 2019, I should say, and you buy it and you're rewarded. Maybe you buy it in May 2019. Maybe you get hurt for a couple of days, but this is a monthly chart, right? Is this monthly?
Yep.
I mean, we're talking about, I'll say this, the most reliable indicator of direction in silver and gold, but in silver is the Commitment of Traders monthly report. You have to have patience. You have to trade it for 3 or 4 bars. 3 or 4 bars means 3 or 4 months, not 3 or 4 minutes, 3 or 4 hours, and you just set it and forget it. And just, you don't buy all of it in one shot, but when it crosses over, you buy. And when it drops again, you say, okay, you buy a third of, let's say you have 3 contracts you buy 1. Because it could drop again. You actually want a dollar cost average. You're almost an investor on these, which brings me to what I said, and I was wrong. This Sunday, I went, look at this. I said, the lines are crossed again. It's tempting to be long silver. And I'm going to tell you why you shouldn't. This is almost word for word what I said. I said, if you look at the last 2 big moves in silver that coincided with the funds getting short and the banks getting long, the 2 big moves in silver that coincided with that, they were during times of the year that were not susceptible to genetic selling. And between August and November, if you look at metals, primarily gold, but silver too, what you have is you have funds are pulling in the reins, they're taking money back, and so they don't reinvest. So you'll see gold typically make a low before Thanksgiving. And silver can go either way, but silver generally follows gold. Silver's a trickier animal. So my point, my thesis, is that what everyone says now? My thesis was, well, we're in the middle of what I call sell season. The funds are closing their positions. If we get a short squeeze higher, short rally, CTA short covering rally, what we're going to have is we're going to have no funds buy it because they don't have any money allocated, which is what I've said before, right? It's the end of the year. They don't have the new allocation. Then I said, and then the Fed's raising rates, and I have a feeling that the pivot is not going to come anytime soon, although I do believe it will come in some way, shape, or form. And I said, and that's the reason why I'd rather be long gold than silver on a spec, right? Now, I'm already long silver on spec, but I did not add. I didn't. Usually I buy strength because I'm a lunatic, but I didn't do that here. And I went, okay, so, I'm expecting silver to go up 50 cents and then down $2, right? And then this happens, last couple of days happen. I go, this is, I went, did the open interest come in? And then the open interest, I'm pretty sure came in. I didn't even look at it. I'm wrong. I don't look at it. I'm in denial, right? But the CTAs are getting punished more than ever. And something I have to admit, I just missed it. It is closing out the year season. So it is sell season if you're in gold. In silver, it's close season. So in the short covering rally during what I call sell season, which is a misnomer, the market rallies 50 cents and the shorts cover, and that's usually it. But everyone's covering because of the Fed. Everyone's covering. And now the Fed might pivot. And so it became rocket fuel. And I missed it. I still have a little bit, a small long, but I missed the trade and I'm killing myself for it. But that's it. So I guess the short answer is when the streams cross, right? When the streams cross, you probably want to stay short if you're a short-term trader, because there's always some sucker who's going to try and sell the lows, like someone who's going to pick up what the Buffett used to say, pick up a cigar off the ground for the last puff, the last pull on it. And so what happens is when that would happen, typically what happened is I'm like, oh, look at that. Everyone's going to start, all the smart people are going to start getting long because it crossed. And as a short-term trader, I'd start to get short and I would play for like a one-day trade. And then, of course, I'd either make money, get out, or I get stopped out and you see one of those long wicks on the candles. I'm like, oh, and the open interest comes in. I go, well, it's time to reverse. And then because I was unafraid to lose money on the way down, and I'm agnostic when it comes to trading, I would reverse and get long. And so my answer is for I think for any people who aren't crazy, is that when the streams cross, as they have done, you want to be biased bullish. You're more likely to buy a dip than you are to buy a rally. Number one. Number two, and this speaks to what you talked about off the air. You mentioned how did you say it? You mentioned well, anyway, it comes down to because it's the end of the year, they were punished more because they're closing out. And you look for the open interest to come in, which it did. And so I missed this rally. Now I'm asking myself, as a responsible trader, because I'm looking for a top, right? I'm looking for a short-term top. Like, I want to sell this and I haven't gotten any signals. I don't have good signals that show reversals. I trade for reversals. I have signals that tell me flatline breakout. I have signals that way. And I'm looking for a signal to give me reversal. I'm not getting one, but I was wrong. So I should assume that I'm wrong now and not trade this and wait for one of my normal signals to come in. For crying out loud, we can go up. We can go up even more. And don't you hate being right and not making money? You know what I mean? Like I don't want to start selling silver now and find out that I was right, that the EFP is a sign that they're buying, that they're, I'm like, oh, it's what do you know, the psychology of regret? Was it Schiller talks about that? I'd be on a ledge, for my next interview with you, just hanging out there going, tell me not to jump, Chris. Anyway, so that's it. That's what happened. The the streams crossed. I didn't add. I should have added. I bought some gold. I did okay on that. But there is one line that I did say before that I want to come back to. I should have emphasized it more. When there's a problem in silver, like an $11 problem in silver, but we went from 4 to 11, and then or a $50 problem. The problem is usually because there is physical buying. Maybe it's Buffett, maybe it's someone else, who knows? And because there's physical buying and the banks see it, the banks start to cover very sexily their shorts, right? And then the market starts gyrating, and the smaller funds start selling it in the hole, looking for momentum. Usually CTAs do that. And it's the short squeeze happens because of the funds, not because of physical. That's that. The rocket fuel in silver is so much bigger than it is in gold because central banks don't buy silver.
Right.
Therefore, silver gets a little bit of free market activity when the banks let it. The banks aren't allowed to let go. I mean, this is me being paranoid, but I know what I'm talking about here. The banks are not allowed to be as free with gold as they are with silver. I have a story about George Soros on that I was told that is true. Silver you can be squeezed with silver. In 94, when Philip Brothers exercises out of the money calls, I was told, well, it was Philip Brothers, right? But their customer, no one ever knew who that was. We know it was 97, it was Buffett. But in 94, it was Soros. And no one's going to tell you that, but I'm telling you that. You can't prove me wrong, but you know what? I'll give you reasons that I'm right. Because the head trader at Goldman Sachs, they were approached by Soros to do it in gold. And he said, this is what the guy said to me, he goes, we literally told him, no way. No way. We're not going to handle that flow. We're not going to do that. We're going to get called and we're going to be in trouble. They were probably borrowing Fort Knox gold and selling it forward anyway. So he went, okay, then I'll do it in silver. And they're like, okay, fine. We'll help you. And so that's how it works. So if we are going to have a fire, a short covering fire, you have all the ingredients for it. Now, mind you, if Powell doesn't pivot, assume that he's not, and this is the short covering rally, it's not people getting long, it's a short covering rally of people getting spooked, and the market will work lower. But the physical buying is real. That EFP buying, I'm jumping around here, but it's important. That EFP buying, EFP is like physical one-hour futures down here, right, in July, and then it went away, and then it came back, and then it went away, and then we did this in silver, and it came back. Not 15 cents, but like 2 cents. I'm like, okay, somebody's buying it again. Or maybe it's not a big buyer. The key is the banks ain't selling it. And that's the key. So I think I'm still bullish.
Well, thank you, Vince. Really appreciate the insight that you shed into that. Certainly exciting times in silver space with one of the bigger rallies that we've seen in a while, and great to get some insight on what's going on beneath the surface that has led to some of those conditions. So hope you found that helpful. Fortunately, that's just part one of this interview. We went a while on this one, and in part two, we dig into a bunch of other things, including where he thinks some of that metal that's been leaving the registered and known London stockpiles has been going to. So we could be able to look forward to that. Real quick before we wrap up, would like to thank Reina Silver for bringing us today's episode of the show. Reina Silver going after 3 high-grade district scale assets. And to give a little more insight onto what they are doing and some of the results they found, here is Lauren McGaugh from a recent presentation where she gave an overview.
Gigi is the other half of the Santo Eulalia district. So you have a carbonate replacement deposit that produced 500 million ounces of silver. And from what we know studying CRDs worldwide, that comes from the distal portion. So where's the source? Where's the proximal starn? And can we find out how much bigger this system could be? Badapilas is Mexico's highest grade silver district. This was actually a native silver district. And what we've done is we've gone in there to a place where the Spanish were looking for gold. They found crazy high grade silver, and they went, okay, I can settle for that. We come in as a silver exploration company, and not only have we found even more high grade silver, but we also found gold for the first time in the district. And our third project is Medicine Springs. That's in Nevada. It's actually the reason why I got involved with Reina Silver. I was actually out there last weekend. And this is a system where we think we have the full carbonate replacement deposit continuum, from porphyry all the way out to the distal portion of the system.
Well, thank you, Lauren. You can find out more about Lauren and Reina Silver at reinasilver.com. With that said, going to say goodbye for today, but hope you had fun, and we will see you again tomorrow.